Welcome to the Explainer. Today, we are getting into the nitty-gritty of the accounting rules that back up one of the most important promises you'll get in your career, your future benefits.
So let's just jump right in with a question that honestly probably keeps some of us up at night. You work your whole life trusting that a pension promised decades from now will actually materialize. But how can you be sure? How does the world of finance make certain that promise is more than just ink on paper?
Well, the answer is a really powerful global accounting standard called IAS 19. You can think of it as the rulebook that tells companies all over the world exactly how they need to account for the benefits they owe to people like you and me. So in this explainer, here's our game plan. We're going to break down how this standard really works. We'll kick things off with its main purpose, then we'll walk through the 4 types of benefits it covers. After that, we'll get into something I call the Great Pension Divide, see how companies basically have to predict the future, and finally, we'll tie it all together to show why this stuff actually matters in the real world. Right, so what's the fundamental goal here? What is this standard actually trying to do at its very core? The whole idea is actually pretty simple, but it's incredibly powerful. For every single hour you work, you're not just earning your paycheck. You're also earning a promise for the future. And IAS 19 says companies have to recognize the cost of that promise right now, as you're doing the work. It has to go on their books as a liability. Basically, it's a debt they need to plan for today, not 30 years from now. Now, this isn't just about one thing. This core principle applies to a whole bunch of different benefits, which the standard neatly organizes into 4 main buckets. First, you've got your short-term stuff, things like your salary and paid time off. Then you have the big one, post-employment benefits, which is mostly your pension. There are also other long-term benefits, for things like a sabbatical or long service leave. And finally, termination benefits for when someone's employment ends. And believe me, this standard gets super specific. I mean, take something as straightforward as paid sick leave. IAS 19 spells out exactly how a company should figure out its future liability for unused sick days. They actually have to look at past employee behavior to calculate a precise number. It's all about turning a fuzzy what if into a hard number on the balance sheet. Okay, but the real beast here, the most critical and complex part of this whole standard, is all about those post-employment benefits. And this is where we see that great pension divide. This slide really gets to the heart of it. On one hand, you have a defined contribution plan. Think of it like a savings account. The company puts in a set amount, but what you get in the end, well, that depends on how the investments do. You, the employee, are the one taking on the risk. A defined benefit plan is the total opposite. The company promises you a specific amount when you retire. It is entirely on them to make sure that money is there, no matter what the stock market does. They take on all the risk. And that, right there, that massive risk is why we've seen companies all over the world shifting away from these kinds of ironclad promises. And this is exactly why these plans are so difficult to manage. Don't just take my word for it. The standard itself says it's complex. Companies essentially have to become fortune tellers, making all these assumptions about how long we'll live, what inflation will look like, and every single one of those guesses introduces risk. So if it's so complicated, how on earth do companies handle it? Well, they turn to this incredible field that's part math, part science, and let's be honest, part crystal ball, actuarial valuation. To get a handle on it all, IAS 19 lays out a very clear 4-step roadmap. First, an actuary has to figure out the gap. What's the total promised amount versus what the company has already saved up? That gives you a surplus or a deficit. Second, that gap becomes the net liability on the company's books. Finally, the process figures out how all these changes hit the company's financials, both its main profit and loss and this other area called other comprehensive income, which is where they report value changes that aren't from their day-to-day business. So this whole complicated process really comes down to 3 key jobs. First, you have to assess the liability. That's the future predicting part. Second, you have to make sure the company is following all the rules and actually has enough cash set aside. And third, you use all that data to make smarter decisions about everything from product design to investment strategy. So look, here's the crucial point. This isn't just some boring accounting rule for people in finance. It has a massive, real-world impact on corporate stability and, more importantly, on the financial security of millions and millions of people. To give you a sense of the scale we're talking about, just look at the life insurance market in one country, Saudi Arabia. It's projected to be worth almost $9 billion this year alone.
That entire industry, which is literally built on making long-term promises, is held up by the exact same principles of actuarial valuation we've just been talking about.
When you boil it all down, IAS 19 is really about trust. It forces companies to be open and honest about the promises they've made. It helps keep them financially stable by making sure those promises are funded, and it gives employees a real layer of security for the benefits they've spent their entire careers working for.
And that brings us right back to where we started. IAS 19 gives us this incredibly powerful framework for accountability. It turns a simple promise into a formal, recognized debt. But the question that always hangs in the air is this: how well does a rule on a page actually translate into real financial security in our own lives?